Good day, traders. This is Roger Scott from Market Geeks, and I hope each and every one of you is having a wonderful day today. Today I have a new tutorial for you, but before I begin, I'd like to remind you to visit MarketGeeks.com for your free swing trading report, and please don't forget to subscribe to our channel for new swing trading videos and trading tips. Whenever the market becomes a bit more volatile than usual, I get tons of emails and calls asking me if swing trading, the E-mini, is a good alternative to the traditional buy and hold trading method. This week is no different. The US stock market is exhibiting extended volatility, and I'm getting my usual phone calls. I guess traders have a pattern just like the markets. When I ask traders if they consider hedging their portfolio or swing trading the E-mini in addition to their trading strategy, I find that many traders are not familiar with the idea. Oftentimes, I wrongly assume that people are aware of swing trading the E-mini or hedging the E-mini and how it can help them reduce risk and or increase profit. The E-mini contract came into existence in September of 1997. The first E-mini contract was the E-mini S&P 500 futures contract. The contract is 1/5 the size of the large S&P 500 futures contract and trades completely electronically 23 hours per day. The E-mini became an instant hit and volume began drifting away from the large S&P 500 futures contract and into the mini futures contract almost immediately. Following the success of the E-mini S&P contract, the exchange introduced a miniature version of the large NASDAQ 100 futures contract. You may have guessed it, the E-mini NASDAQ was name given to the miniature version, and it's also 1/5 the size of the large NASDAQ 100 futures contract. Additional E-mini contracts started coming out with the E-mini Dow Jones following the release of the E-mini NASDAQ futures contract. Many fund managers and professional traders abandoned the large contract and switched to trading the E-mini futures contract. Here are the specifications that you need to know. The E-mini S&P is valued at $50 a point. Multiply the value of the S&P futures into the $50 and you will get the value of the contract. Each point move is equal to $50. The E-mini NASDAQ contract is valued at $20 times the value of the NASDAQ 100 index contract. Remember, each point move in the index futures contract is worth $20. The E-mini Dow Jones contract is valued at $5 times the value of the Dow Jones Industrial Index contract. Each point move equals $5. There are two ways traders primarily trade the E-mini contracts. The first way is to hedge an existing portfolio of stocks. For example, let's say you're currently holding $50,000 worth of stocks that are primarily made up of technology companies, and you think the market is going to have a sell-off. To hedge your portfolio, you would sell approximately $50,000 worth of E-mini NASDAQ futures contracts to offset the loss to your portfolio if the market drops. That means one E-mini NASDAQ contract would hedge a technological portfolio made up of $50,000 worth of technology stocks. The type of stocks that make up your portfolio would determine which E-mini contract you would need to sell. If your portfolio was primarily composed of blue chip stocks, then the E-mini Dow Jones would be your first choice. If on the other hand your portfolio is composed of a mix of stocks, then the E-mini S&P futures contract would be the obvious pick. Your stock portfolio is the primary determining factor in choosing the correct index to trade. In addition to hedging, the E-minis have become tremendously popular markets for both swing traders and day traders alike. There are three major reasons for this increase in popularity, in addition to avoiding having to pay multiple commissions for individual stocks and having to monitor many different stocks at the same times. There are three additional reasons for the growth and popularity of the E-mini contracts. The first one is contract size. Before the small contracts began trading, the only other option was to trade the larger ones, and they were just too big for most traders. Most traders just couldn't afford the risk and the large leverage the big-sized contracts needed. Imagine you're just starting trading and entering a large S&P 500 contract. If your contract moved 3 points, you would be out of $750. This was just too much risk for small traders. Execution. Since the E-mini contracts are traded electronically, the execution is literally instantaneous. This makes it ideal for swing trading the E-mini and is very different than when trading the large pit traded index futures contract. Pit execution has not changed in over 100 years. Each step from entering an order to filling the order to getting your fill back is done by people, and mostly different people. So it can take anywhere from 30 seconds to 2 minutes to get a fill, and I'm being conservative. Can you imagine what type of movement the index can produce in that amount of time? That's the second reason why E-mini contracts are so much more popular than the larger counterparts. Access. The E-mini contracts are available almost 24/7. What this means to you is that you can enter and exit the market at any time of day or night. The larger contracts are pit traded. This means you cannot enter or exit orders on the weekends, and there are large breaks between the day pit session and the evening session. The spreads between the bid and offer are substantially wider because there is lack of liquidity when the large contract is not being traded in the pit, and it's only being traded in the pit during regular stock market sessions. These are the 3 reasons why the E-mini contracts became and remain very popular to hedge and to speculate. In the coming weeks, I will be doing several tutorials and trading strategies using these contracts. That's it for today's video tutorial. Please visit our website marketgeeks.com for your free swing trading report. And don't forget to subscribe to our channel for swing trading videos and trading tips. If you have any questions, please don't hesitate to contact me at rscott@marketgeeks.com.